My Australian dividend series has over 200,000 views, and in this video, I'll be sharing the top 10 Australian dividend stocks at the midpoint of 2025. I'll be using a screener from today's video sponsor, Stockopedia. They have a fantastic platform that offers investors several market-leading options, including screening and portfolio tracking tools, as well as all the metrics you need to do in-depth research on over 63,000 stocks from all over the world. Australia has over 1,700 listed stocks, so having a tool like Stockopedia can help you filter and sort your way through. This leaves you with only the best of the best. In this video, we'll find Australia's top 10 dividend options right now, dive into what they do, how they make their money, and of course, their dividend history and yield. First up, we want to narrow down our 1,700 listed Australian stocks to only those paying a dividend yield of at least 5%. ANZ currently offers a return of 3.9% on their term deposits, so setting a floor at 5% ensures we have a fair return for the additional risk of investing in shares. That leaves us with 160 stocks. Second, I like to filter out the smaller companies. As a dividend investor, I want strong blue chip stocks that have been around for a while and built economies of scale. For good measure, let's go with 100 million Australian dollars, bringing us down to just 120 odd stocks. Dividend yield by itself can be a tricky metric, as it takes the previous year of dividend payments and divides that by today's price. If the price has dropped 50% over the past year, the yield would be artificially inflated, despite investors obviously trying to sell out of the stock. As dividend investors, having a reliable payout is critical. By changing our stock list from a table to a graph, we can see some stocks here have dropped in price over the past year, like Yancoal and Lindsay Australia. To filter out these potential dividend traps, I use a 1-year absolute price change filter of -5%, which leaves us with around 70 stocks. I also like to look at the 5-year price trend, as over the long run, we'd expect our initial invested capital to be preserved. If the 5-year price movements are negative, we may as well put our money in a term deposit, where it's potentially safer. Jumping into the charts, we can change our term period to 6 years. As you can see, there have been some horrific price movements in some of these stocks, like Wham, Pepper, Magellan, among others. So if we scrape those out, we're left with 41 stocks. Next, let's apply a minimum and maximum dividend payout ratio. This is the percentage of net profit paid out to shareholders as dividends each year. Anything below 60% could mean the business requires substantial capex each year to remain viable, while anything above 100% means the business paid a larger dividend than the money it made. In the short term, this inflates the yield, but in the long term, obviously they might need to start filling that hole with debt or cash. Once we apply these filters, we get 20 stocks. Next, I like to remove a few sectors from consideration. These are usually investment trusts or REITs that don't often operate like a traditional business. They trade assets, are sometimes seasonal, and overall not something I look for in a dividend stock. That brings us down to just 11 stocks. And finally, one cool feature you only get with Stockopedia is their StockRanks score. For every single stock, they weigh up 3 primary drivers of stock market returns: quality, value, and momentum. Behind each driver, the Stockopedia team scans through the financials and assesses various factors, giving an eventual score. When they bring these 3 scores together, they come up with a StockRanks score, which over time has shown to be a positive indicator of a stock's strength. It's by no means a perfect science, but it is a positive indicator. Applying a filter to eliminate any stocks with a stock rank of below 80, we get our final 10 stocks we'll be looking at in today's video. Let's jump into our first stock, Ive Group, ticker IGL. They're a leading Australian marketer with over 2,000 staff and revenue of around $1 billion a year. They have operated for over 100 years, and their 2,800 clients include many household names like Woolies, Coles, Sanitarium, Westpac, and McDonald's. The company has a market cap of over 400 million Aussie dollars, and over the past year, they've seen a decent uplift in their stock price. Stockopedia has also given them an exceptionally high score for all 3 stock drivers, with an overall score of 100. Despite seeing minimal revenue increases over the past year, they did see a decent uplift in profitability. Over the past year, they've held their dividend payments steady at 18 cents a share, paid in their equal parts half-yearly. Based on the current stock price, this gives the Ive Group a very healthy dividend yield of 6.3%. The dividend stability also looks to be improving in line with the increase in profitability and dividend cover in recent years. The company has a good cash balance, the equity position is improving, and as a marketing company, the capex requirements are also minimal. Investors are obviously pouring into the stock, and it may be an interesting option for dividend investors to take a closer look at. Our second stock is Motorcycle Holdings, ticker MTO. Founded in 1989, today they're Australasia's largest motorcycle retailer and distributor with over 45 locations. They have a market capitalization of $175 million, have steadily increasing revenues now exceeding $600 million a year, and Stockopedia gives them an exceptional StockRanks score of 99. With the stock price up 138% over the past year, investors have been very positive on the stock. Over the past year, Motorcycle Holdings has paid investors a dividend of 15 cents, 8 as the interim payment in March and 7 as the final in October. At the current stock price, this gives the stock a dividend yield of 6.3%, the same as Ive Group. The stock has a positive dividend cover of 1.5 times, an improving balance sheet, and a fairly stable cash balance, having recently written down some debt. So it's certainly a popular stock, and dividend investors have to weigh up the long-term prospects of motorcycle retail. The third stock is Cash Converters, ticker CCV. With 668 global locations across 15 countries, Cash Converters is a long-time pawnbroker that many of us will have grown up with. Beyond just trading second-hand goods, they also offer loans, which of course can be a strong earner if managed well. Like the other stocks we've covered so far, Cash Converters has appeared in several of my previous videos and continues to be favored by the market. The stock price is up 27% over the past year. Today they have a market capitalization of $170 million, steadily growing revenues, and an improving profitability situation. Stockopedia rates them highly too, with a stock rank of 99. Over the past year, Cash Converters have paid a dividend of 2 cents, one in October and the other in April. With the current stock price of 28 cents, this offers a very decent 7.1% dividend yield. Generating free cash flow of 7.7 cents a year and a dividend cover of about 1.5 times, Cash Converters looks to have a strong financial situation to continue paying a high yield. With the cost of living situation continuing to worsen for many, companies like Cash Converters tend to do well, catering to the lower middle classes. Fourth up, we have another long-time feature, Shaver Shop, ticker SSG. They operate over 120 stores across Australia and New Zealand, specializing in the retail of hair removal products. They have a market capitalization of $180 million. They have stable revenues, however they have seen their profitability slide slightly over the recent years. This has slightly dropped their value score, but overall, Stockopedia gives them a positive 99 StockRanks score. A plus point for investors is their increasing dividend payment, up slightly to 10.3 cents a year. March's interim payment was 4.8 cents, while September's final payment came to 5.5 cents. That takes their dividend yield to 7.4%, the highest in our list so far. However, dividend investors need to watch out for Shaver Shop's declining dividend cover. At 1.09 times, that means over 90% of profits are paid out as dividends, which is up towards unhealthy levels. This metric is being squeezed by the slight increase in dividend payments, but a decrease in the earnings per share. If this continues, Shaver Shop may need to reduce their dividend payments in line with the falling profits. On the positive side, the stock has relatively low levels of debt, and from a cash perspective, it's actually very cash generative with minimal capex. Our fifth dividend stock is a new one in my videos, Inghams, ticker ING. Since 1918, Inghams has supplied chicken and its related products throughout New Zealand and Australia. Today they hire over 8,000 people and have slightly diversified beyond chickens to turkey products and stock feed. The stock has a market capitalization of 1.3 billion Australian dollars, and looking at their stock chart tends to move up and down in a wave motion, spanning years. Stockopedia gives a StockRanks score of 98, largely on account of its quality attributes. Digging into that, we can see Inghams' revenue slightly increases year after year, averaging a 5% increase since 2019. Profits, however, appear to be more cyclical. At a quick glance, the stock price seems to rise and fall in line with its level of net profit. So Inghams is definitely not a growth stock, but one you might be able to time your entry into. Over the past 12 months, Inghams have paid a total dividend of 19 cents a share, slightly down on a year prior. The interim payment in April came to 11 cents, while October's final came to 8 cents. On a current stock price of $3.55, the dividend yield comes to 5.4%. The dividend cover of 1.26 times is on the lower end as compared to other stocks we've looked at. However, as we can see, a declining net debt over the past 5 years or so, this indicates it's an affordable level for the company to pay out. If net debt increased either through declining cash or increasing debt, then it would be a concern whether the dividends were in fact affordable. Despite paying a 5.4% dividend and using 39% of operating cash on capex, seeing they were able to knock $100 million of debt off the books is a sign of Inghams being a well-run business. Up sixth is another common feature, GR Engineering Services, ticker GNG. They're a process engineering company operating mainly in the mining sector. It's a diverse field which requires a lot of technical expertise in efficiently assembling equipment to extract minerals. GR Engineering has a market capitalization of $500 million, a 44% increase in stock price for the year, and Stockopedia has given them a high StockRanks score of 98. Revenue has slid over recent years, however recent releases suggest this might be turning back. Despite top-line pressure, profitability is tracking well. Over the past 12 months, GR has slightly increased their dividend payments to 20 cents a year, with 10 cents paid out every 6 months. This puts their current dividend yield at 6.5%. Like we saw with Inghams, the dividend cover is on the lower side of things at just 1.14 times. For a few years, it was even below 1. This indicates the company paid more in dividends than it earned. You can actually see in Stockopedia's stock report that cash was being drained simultaneously. Now that the dividend cover has returned above 1 to its highest level in recent years, cash is being replenished. With very little debt, GR has a clean balance sheet and cash flow statement with growing equity and a healthy return of capital to investors. Seventh, we have another new stock, Kina Securities, ticker KSL. They're a bank servicing Papua New Guinea, offering end-to-end services such as savings accounts, loans, and financial advice. With the stock price increasing 37% over the past year, there's a few factors that have got investors excited. The stock has a relatively low PE ratio when compared to Aussie banks. It has strong revenue growth at a CAGR of 18.6% over the past 5 years, and the same for profitability, growing at 10.5%. With a market capitalization of $360 million, it's a relatively small financial institution, but with results like these, they're finding opportunities. Stockopedia acknowledges their small size in their quality evaluation, but with positive value and momentum characteristics, they're given a stock rank of 96. Dividend payments have remained at about the same level over recent years, and the dividend cover has remained at around 1.3-1.4 times over the past couple years. Looking back at their reports to the ASX, over the past 12 months, they've paid total dividends of 10 Australian cents, equating to a yield of 7.8% on the current traded price. Alongside strong improvements in their revenue and profitability figures, their balance sheet is fast improving, and their cash balance is improving too. So if you're interested in financial services stocks, this might be an option to consider. Another financial services stock, but one that often pops up in these videos, is Helia, ticker HLI. With a market capitalization of $1.5 billion, Helia is an insurance company that specializes in lenders' mortgage insurance. Lenders work with Helia to insure against potential losses in the case a borrower forecloses and the bank can't recoup their initial investment. Often, this comes at a big cost to low equity borrowers. A large piece of news from the past 12 months is CommBank's plans to use another vendor for LMI lending from the end of the year. Last year, they accounted for 44% of Helia's lending, so this is a major hit. Due to the financial treatment of LMI premiums, Helia likely won't see an immediate financial hit, but it may reduce their prospects for future business. So this is something for investors to consider. It could also explain why Stockopedia has cut their quality score to just 51. Despite all of this, Helia's stock price has returned and even surpassed its previous highs, now sitting at $5.50. Revenue is flat, profitability has been declining, but this is a hugely profitable sector, and the stock still has a whopping dividend cover of 2.5 times, by far the biggest in this video. Over the past year, Helia has increased their dividends to a whopping 84 cents, taking their dividend yield to 15.3%. They paid an interim, a final, and a special dividend payment over the year. So if we assume the 53-cent special dividend was a one-off, the yield stands at 5.6%. So investors should look closely at the CBA news and assess whether it is likely to affect Helia's dividend payments. Next up, we have Korvest, ticker KOV. Korvest is an Australian industrial company that manufactures and supplies essential gear for big infrastructure builds. They also offer galvanizing services, which means coating steel to prevent rust, crucial for construction projects across Australia. They have a market capitalization of $127 million, revenue has been flat over recent years, and profits are slightly declining year over year. According to Stockopedia, the company has strong quality attributes but has some issues around the value and momentum factors. Zooming out to a 5-year graph, the momentum looks to be up and down in the short term but tracking pretty well over a number of years. Korvest has a culture built around dividends, having paid them consistently since the 1980s. Over the past year, they've increased the payout to 65 cents, with 40 coming in September and 25 in March. On their current stock price, this gives them a dividend yield of 6%. With dividend cover of 1.23 times, it's on the low end. However, the growing balance sheet, minimal debt, and low capex suggest it is something they can afford. And finally, our 10th stock is Globe International, ticker GLB. Globe sells apparel and skateboarding equipment in 70 countries around the world. They were founded in 1985 by 3 Australian brothers, and today they turn over $210 million of goods each year. Globe has a market capitalization of $124 million, but in recent years has struggled with declining sales. Over the past year, they've paid 23 cents of dividends, slightly up on last year. On the current stock price, this gives Globe a dividend yield of 7.6%. Their dividend cover is a bit low at 1.19 times, but the company has a strong cash balance and low levels of debt to maintain current dividend levels. So Globe remains profitable, but doesn't appear to be growing, a bit like their stock price over the past year. So the stock has a high dividend yield, but it does appear to struggle maintaining its customer base. If you enjoyed this video and want to give Stockopedia a try yourself, make sure to check out my link down below in the video description. Honestly, digging through stock documents to find the right data can be a nightmare, but Stockopedia does all the heavy lifting for you. It pulls in the financials, charts, ratios, dividends, insider transactions, you name it, and turns them into clear, easy-to-read dashboards. With their screener tool, you can instantly filter thousands of companies on hundreds of attributes. Or you can simply leave it to the Stockopedia experts and use their preset screens that align with their StockRanks system, or follow the same processes as well-known investors via the Guru screens. It's like having a team of analysts in your pocket. I use Stockopedia all the time to explore the market, and as I use spreadsheets all day in my job, it's nice to have a tool instead of doing the same for my investing. So if you want to give them a go, make sure to use my link down below in the video description, or use the coupon code BC25 at the checkout. Viewers of my channel are entitled to a 14-day free trial and a 25% discount offer on any annual plan. And if you want to see more dividend investing content, make sure to check these videos out here. Don't forget to subscribe, and I look forward to catching you in the next video. Cheers.